Hello, and welcome to this webcast on non-GAAP measures and fraud risk. I'm Cindy Fornelli, Executive Director of the Center for Audit Quality, and I'm pleased to moderate our discussion today. This event is brought to you by the Anti-Fraud Collaboration, which brings together the joint efforts of the Center for Audit Quality, Financial Executives International, the National Association of Corporate Directors, and the Institute of Internal Auditors. We have an important and complex topic today: the use and potential misuse of financial measures presented outside the audited financial statements that do not conform to U.S. Generally Accepted Accounting Principles, or U.S. GAAP. Non-GAAP measures can provide important insights into a company. But what happens when non-GAAP measures are not transparent, consistent, or comparable? What are the implications for fraud risk? We'll explore these questions and more today. So now on to today's program. Slide 3 sets out our 3 goals for this webcast. First, we'll take a step back. What exactly are non-GAAP measures and why do companies use them? Then we'll drill down into what non-GAAP measures are appropriate and when they're appropriate, and when might they be misleading or even a sign of potential fraud. Finally, we'll take a look at the oversight responsibilities of various parties in the financial reporting supply chain with respect to this complex area. We have a great panel of experts to help us meet these objectives. So let's turn to slide 4 for a quick introduction of each panelist. Starting in alphabetical order, I'll begin with Phil Billington, who is Vice President, Internal Audit at HCA Healthcare Inc., which is a Fortune 100 healthcare company with over 180 hospitals, 120 surgery centers, and various other healthcare facilities operating in 20 states in England. So Phil, it's great to have you.
Thank you for having me.
Also with us is Heather Dixon. Heather is VP, Controller, and Chief Accounting Officer at AETNA, a Fortune 50 diversified healthcare benefits company. In that role, Heather is responsible for controllership, tax, SOX and internal controls, SEC and statutory reporting, and finance shared services for the company. Heather is also a member of the Committee of Corporate Reporting of FEI. Heather, I'm very glad to have you.
Happy to be here.
Our third panelist is Keith Higgins. Keith serves as the chair of the Securities and Governance practice at Gray LLP, which is a preeminent global law firm. Previously, from May 2013 through January 2017, Keith served as the director of the Securities and Exchange Commission's Division of Corporation Finance. Keith, welcome.
Great to be here, Cindy.
And last, but by no means least, is Serena Wolfe, a partner at EY. Serena is EY's Central Region Real Estate, Hospitality, and Construction Leader, or RHC, and manages the go-to market efforts and client relationships across that sector. She is also EY's Global RHC Assurance Leader. She has worked in a variety of industries, including manufacturing, technology, and real estate. So Serena, we're glad to have you too.
Yeah, thanks for having me, Cindy.
Now, moving on to slide 5, let's turn to the issue that is the centerpiece of our program, non-GAAP measures. The CAQ hosted a series of roundtables on non-GAAP measures in which 2 of our panelists participated. Keith was our moderator and Serena was a participant. We explored the perspectives of various stakeholders on this topic and issued a report, a roadmap for audit committees, in March of 2018, summarizing the key themes that we heard in those roundtables. The CAQ's report and our discussion today will help promote a greater understanding of all stakeholders' roles relative to non-GAAP measures. As our audience is well aware, most companies in the United States prepare their financial statements in accordance with U.S. GAAP, which provides a common framework to account for transactions. GAAP is the foundation for confidence in our financial statements because it is relevant and reliable and provides consistency and comparability. We will discuss how non-GAAP measures can provide additional insights about a company's results of operations, financial position, and liquidity. But when not used appropriately, these non-GAAP measures can present certain risks and challenges. Today, our discussion will focus on measures that meet the SEC's definition of a non-GAAP financial measure, as well as key performance indicators, or KPIs, that may be commonly used. So, Serena, I've used the term non-GAAP measures and KPIs already frequently in our brief time together. So let's level set, and can you start by explaining to our viewers what we mean by non-GAAP measures? What are non-GAAP financial measures? What are KPIs? Kind of give us a primer, if you will.
Sure, absolutely. So you can bucket performance reporting into three categories. So you've got GAAP performance reporting or measures, non-GAAP, and key performance indicators or KPIs. And so a GAAP performance measure would be something that is dictated by the FASB. So it would be net income, earnings per share, operating cash flows, those types of items that are readily disclosed or presented on the financial statements already. Non-GAAP is an alternative performance metric to a GAAP performance metric. And though a non-GAAP measure could very well be based off GAAP financials, so it's a calculation derived from GAAP financials, but it could also be something that companies put together which differ from GAAP accounting principles, so it is presenting a tailored or a customized performance measure in order to enable a company to tell its own story. And non-GAAP measures are very often earnings measures of some sort, EBITDA, funds from operations, FFO, NOI, those types of net operating income, NOI, those types of examples.
So turning to slide 7, what about non-financial measures?
Yeah.
We hear about those too, right?
Yeah, and I think that people often get a bit mixed up between, is it a KPI or is it a non-GAAP measure? And a KPI, or a key performance indicator, the best way to think about the difference between the two is that KPIs often incorporates non-financial information. It could be a financial measure, but more often than not it's based, or it incorporates some sort of non-financial measure. And so a KPI could also be somewhat anchored in GAAP if it's a revenue measure, for example, but often the incorporation of a non-financial measure would mean that it's not based on GAAP, and therefore those types of things would be, as illustrated on this slide, square footage, occupancy percentages, number of subscribers,
sales, we hear sometimes,
customers,
right?
Number of customers, that type of thing. Yep. And so why does it matter, I guess, is the question. And I think the difference, the importance between the differential definitions is just that the SEC has rules and regulations around non-GAAP measures in Reg G, and also other aspects of the guidance which would require you to complete certain reconciliations. And they've also released other guidance, which I know we're going to talk about later.
Well, so that's a good segue over to you, Keith, and going to slide 8.
Yeah.
So in May 2016, while you were at the SEC as the director of Corp Fin, the SEC released a compliance and disclosure interpretation, or CD&I, on non-GAAP financial measures. So what was the genesis of that guidance, and perhaps more importantly, what are the key elements of that guidance?
Sure, Cindy. Well, in 2016, the GAAP rules have been, the rules for non-GAAP have been around for about 15 plus years now, and the pendulum has sort of swung a little bit about how the SEC has felt about it. I think by 2016 what we observed was that the vast majority of companies were using non-GAAP financial information. Well over 80% of the S&P 500 used it in their earnings release. It was ubiquitous. And one concern was non-GAAP seemed to be crowding out the GAAP information, certainly on the prominence side, on what media outlets picked up, and even on what analysts picked up. It wasn't always clear when the communications came out what was being talked about, and we thought that part of it was non-GAAP was beginning to obscure the GAAP information, and the reason the SEC likes GAAP and the FASB likes GAAP is it provides consistent, comparable information that can be used across companies. Non-GAAP is bespoke. Each company creates its own non-GAAP, and that creates a challenge. So we looked at the guidance and updated it to reflect some concerns we had. Prominence being a big one. I think people had gotten a little lazy, or they saw everybody else everybody else was jaywalking, and they figured, why shouldn't I be able to jaywalk as well? I mean, it was hard. And so there was a lot of, you'd have the non-GAAP in the headline, and you'd read the GAAP, 3 paragraphs down, and they'd say, well, it was still there. So prominence was a big issue, but there were also things like individually tailored accounting principles, where a company that recognized revenue on a subscription basis really preferred to show when the cash was coming in and accelerate the recognition of that revenue. So they'd show an adjusted revenue. That was a concern because we felt as if the financials have to be tethered to something. There has to be some North Star that guides everything, and revenue seemed to be a pretty basic thing. So the staff was pretty much concerned about individually tailored revenue recognition. Tax was another one. Companies would add back all sorts of expenses, and then when they come to the tax line, they would put in what the cash tax was paid. Well, of course, the cash tax paid was benefited by all those expenses that they just added back into the number. So there were things like that I think needed to be addressed, and that was the purpose of the guidance. We certainly on cherry picking was another thing. If you're going to add back in one-time expenses, well, you got to back out one-time gains. Seems pretty, and companies are generally pretty good at it, but you often don't see that, and it was a good reminder on that. And on the equal or greater prominence, we probably were a little aggressive in the interpretation. The rule says the gap has to be equal or greater prominence, and the view of the staff was that you couldn't really have equal or greater prominence if the non-GAAP went first. So that was sort of a step in the direction. And by and large, I think that went relatively well. Companies, I think, were happy to, maybe not happy, more or less happy to comply with it, and I think the compliance got a lot better. People started paying attention to it, and I think it was a healthy exercise.
So, Heather, I'm going to ask you, were you happy about it?
No. Of course we were happy to comply.
But let me rephrase. That wasn't a fair question.
Right.
But what did AETNA do when the CD&I came out, right? Did you step back and say, okay, here is some guidance, some direction by the SEC? How did you guys look at that, and what did you do?
We really did a full process to look at the CD&I. We looked at all of the external disclosures that we have, regardless of where those appeared. We looked at the internal nomenclature that we used. We made sure that it was really a tone change. So even a small item like renaming the measure that we follow in accordance with some of the guidance that came out to make sure that it was clear. We used that throughout the building, and so we make sure that everyone's speaking the same language. We focused on the prominence, we focused on the conversation that we had around those items that were part of our non-GAAP measures. We looked at how we disclose them, we looked at how we reconcile them, and we really focused on every piece of information that was out there. So for us, it was an end-to-end process. And maybe back to the happy comment, Keith, it was an opportunity for all of us to do it at the same time. And so as a preparer, you want to make sure you have that consistency across the marketplace so that when people pick up your financials, they have some benchmarks to anchor to. And so it really was an opportunity for us to compare notes with other preparers and make sure that we were all thinking the same way.
So moving on to slide 9, lest our viewers think that non-GAAP measures are bad, there are benefits to using them. And so, Phil, I want to ask you, what are the types of non-GAAP measures you use at HCA, and why do you consider them to be useful or successful?
Sure. So Keith talked about prominence, and the most prominent of non-GAAP measures within the entire healthcare industry, and particularly at HCA, is EBITDA, or earnings before income, interest, taxes, depreciation, amortization. And that one, we'll talk about some of the risks later on, but that's derived from the financial statements. You can recalculate that, but consistency will be the key as we talk through some of these things. But it allows a company to tell its story in a way that the financial statements may not allow. You are better able to compare company to company, period to period for the same company, particularly in the same industry. And then when you get into adjusted EBITDA, where you are removing some of those non-recurring items that Keith mentioned, you're getting at true operations. And that's what the investment community is looking for.
So, Heather, same question to you. What kind of non-GAAP measures does AETNA use?
We use similarly, we use an adjusted earnings measure and then derivations of that. So adjusted operating expense ratio, for example, which is based off of the adjusted earnings measure. And we follow some of the same basic principles. We're really striving to get to what is the underlying core performance of the business. And so what is it that could be misleading or even something that could skew numbers if people don't really have a good understanding of that, and if we don't make it clear that it's something that's not part of the normal business operations. And so we of course look at those, whether they are coming in to adjusted earnings or being excluded from adjusted earnings. We make sure we look at those things so that we have them on a comparable basis. And we really focus on putting enough disclosure in so that it's clear why we have excluded or included those items, and then we make sure that we really look at them on a period-to-period basis to make sure that we're keeping to the tone of what the policy is that we're trying to set to really get to the underlying performance of the business.
So, Serena, Keith mentioned bespoke non-GAAP measures, and I think both Bill and Heather just alluded to the fact that in certain industries, certain non-GAAP measures are more common because it helps the company tell their story. So you see across a variety of industries or sectors in your work as the external auditor. What are some other common non-GAAP measures that are used in particular industries?
Yeah, so as I mentioned before, earnings measures are the most common, and for the last 13 years or so, I've devoted my entire career to the real estate industry, and public real estate companies, particularly real estate investment trusts, benefit from having a defined non-GAAP measure, which is referred to as funds from operations, or FFO. So NAREIT, the National Association of Real Estate Investment Trusts, in 2002 issued a white paper outlining the definition of FFO, and they've had some various interpretations and modifications to that as GAAP has changed and other things have happened over the years, but the definition is still intact. It is recognized by the SEC as a defined non-GAAP measure, and so I would say that industry benefits somewhat from having some bit more uniformity, a bit more of a definition around a non-GAAP measure. And NAREIT does review financial information every few years and assess the compliance with their definition. And at the last time that they did do such a review, compliance was very high. It was in the 90-odd%. But what happens is then a company wants to tell their own story, and suddenly other measures come out: adjusted FFO, core FFO, some other type of measure. And the SEC does require companies, if they do show an adjusted FFO measure, to actually reconcile to FFO and not as well as net income. So there are those reconciliations that are required. But EBITDA is a very common measure that is used in many sectors and industries. And you may say, well, come on, how difficult is an EBITDA measure? Isn't it just EBITDA? Well, no, it's not, because companies do take different types of interpretations and may do an adjusted EBITDA or what have you.
In fact, isn't it more common that they would do an adjusted EBITDA? I mean, I think it's pretty rare for a company just to present EBITDA, because there's always other adjustments that you're going to, or even not so much non-recurring. They're items that
non-recurring, recurring items.
Yeah, exactly.
So you do see some consistency with the actual measure that is being used. So maybe it's EBITDA, or in asset management, it's economic net income is a measure that they use in the asset management industry. But you definitely see divergence within how the companies interpret it, because something might happen for that company in a particular period which they want to highlight, right? And so that's where the inconsistency or the comparability issues arise.
So Keith, and all of you, we're going to turn here in a moment to talk about the risks and challenges presenting non-GAAP measures. But we've got a couple of questions here from our audience that are a little dubious as to the benefits, or isn't it a ploy by companies to obscure their real financial positions? So if you could, since you were at Corp Fin and obviously you were concerned about some of the abuses, what are give us a little bit more about the benefits and why the SEC is okay with non-GAAP measures, as long as you comply with the CD&I.
Absolutely. I mean, I think that, of course, there's a good reason to be skeptical companies want to tell their story, but they always want to tell the best story that they can. And I think that Corp Fin reviewers are appropriately skeptical when looking at a company's financial statements and the non-GAAP measures that they present. On the other hand, a non-GAAP measure, it should be the result of an analysis of the company's operations. It should really be that end result of the analysis of the company's operations, which is what a good MD&A should do. So there's nothing inherently wrong with non-GAAP financial information. One wonders whether at some point, if everybody's presenting the same non-GAAP information, whether FASB ought to think about GAAP, whether GAAP should be changed. But that's and they're responsive to that and are looking at it. But no, I don't think the SEC is against it. I think full transparency is certainly important. I think, secondly, there are some bridges too far, if you will, and things like the alternative revenue model. I think that the staff just said no. But I think that, of course, companies want to present things the best way, but that doesn't necessarily mean it's wrong, but it does mean that you probably need, because these are bespoke, because they are creating their own adjustments, I think you need to be a little more diligent in looking at it.
And I might just add to that a little bit. When we think about the reason we use non-GAAP measures, we're presenting what we feel is the most accurate picture of the results of the company. And sometimes it looks better and sometimes it looks worse. Those adjustments go both ways. And really, if you think about it, that's how we run the business. Those are the numbers that we base business decisions from. And so when we think about what we want the public to see as well, we want it to be clear what those different pieces are so that they understand all of the different parts of the business.
Anyone else?
I would just add, Keith mentioned transparency. I think I would just add consistency. From an internal auditor perspective, that's what I'm looking for within my company. I can't control what another company is disclosing, but I can control what we're disclosing. And that transparency and consistency, those are the key items that we look for.
Yeah. And certainly, when you see a schedule of adjustments and you see one of the larger adjustments is other, there's good reason to ask what's going on behind other. But those are the questions that Corp Fin reviewers ask. They're questions that audit committees ask. They're questions that management should be asking, and analysts certainly do.
For sure.
Well, so that's a good segue, going over to slide 10. And we are going to talk about, you mentioned audit committees, you mentioned other parties that have responsibilities around a company's presentation of non-GAAP measures and KPIs. But let's talk more generically first about the unique risks and challenges. And as our questioners asked, they suspect there are some risks and challenges for using non-GAAP measures. So Phil, I'm going to start with you. You've talked about, I asked you, what are the benefits? Let me ask you, what do you see as some of the potential pitfalls?
Well, I think inherently these non-GAAP measures have more risk. Some of these non-GAAP measures are derived from the financial statements. So you can put those in one bucket. But then there's this other bucket that would include data that's coming from another source, or maybe it's a mixed source. And so we'll talk about some of the risk factors later on, I know, but the highest risk factor that we look for are in these non-recurring areas. So what are you backing off EBITDA to get to that adjusted EBITDA number? If you've done that same type of back off before, were you consistent in the calculations? Was the same person or team associated with that calculation consistent? What kind of controls and reviews are in place around that? These are some of the pitfalls that we look for.
So Keith, we've talked about transparency, and so I know from our roundtables that a number of the companies that participated said that they're very transparent about the non-GAAP measures they use, how they use them, why they use them, and how they're calculated.
Right.
So if there is that kind of disclosure and those kinds of controls around non-GAAP measures, can they still be problematic or misleading?
They can be. I think it's not frequent. I mean, I think if all the disclosure is there and it's laid out in a transparent fashion, that's going to get you 95% of the way there. On the other hand, there are some things. I mean, you remember the Groupon not to call out any particular, but that got a lot of press. I mean, they backed out in a very transparent way basically all of the company's operating expenses from their adjusted segment operating income, I think, adjusted consolidated segment operating income. And I think the SEC thought that was a bridge too far, and I think many analysts and other observers, based on the publicity they got, thought that was the same thing. So I think that can be misleading, even with the kind of transparency that you have. I think the biggest problem is if you go just to that headline number, adjusted EPS for the quarter was X, people are hitting that like a shiny object and not looking at how you got to it. It's not like the math professor that said, I don't care about the result. I want to see how you got to the. I want to see how you. I want to see your work.
I always just like that because I could never justify my work.
Right. But that's really what the appropriate way is. And in this day of algorithmic trading with bots scraping press releases to get ahead and get a trading advantage, you wonder, wait a second, when you're putting that out, how do you know that the way that they calculated adjusted EPS for the quarter didn't change? If the focus is just too much on that number. So I think that's one of the concerns that certainly when I was at the SEC we had as regulators about that it was important to understand how the company got to the result, and less important almost to know exactly what that number turned out to be.
I'm going to ask you about a phrase that I had not heard before our roundtables, and that's anti-GAAP.
Anti-GAAP, yeah.
Explain to us what anti-GAAP is.
Well, as the only lawyer on the panel, I think would be a little odd for me to do that, but I'll jump in.
Well, I think from your SEC perspective.
Yeah, but I think anti-GAAP is just the incorrect application of GAAP. It's not like you're trying to present a non-GAAP number, taking a GAAP number and backing out particular things. It's you're misapplying GAAP. It's like you have a employment agreement in connection with an acquisition, and there are ways where it could be considered to be capitalized into the acquisition, and there are ways when it's just considered to be a contract, an employment contract that should be expensed as incurred. And so, doing it the wrong way is not GAAP. It's anti-GAAP. It's simply incorrect GAAP. So I don't know anybody.
It's not against GAAP.
It's
just
right, exactly.
Not GAAP.
You're doing it the wrong way.
That's right.
And even if appropriately disclosed, anti-GAAP is still not appropriate.
Correct.
Yeah.
Right.
So Heather, what are some of the concerns you have about AETNA's, or in general, the use of non-GAAP measures?
So if I think in general, I'd put them in a couple of categories. I mean, the first concern that I would focus on is subjectivity, because you can put a policy around most of the disclosures and the calculations that you include, but it's those non-recurring items, specific transactions that come up in the course of business where there is subjectivity to be applied. And so I think it's important to take as much of that subjectivity out, and then where you do need to have subjectivity, to have some controls in place around that and make sure you have the appropriate levels of review and the appropriate approvals so that you ensure you get the best disclosure. And I think one of the things I focus on is communication and the disclosure around those adjustments. And we know that the analyst world is going to make those adjustments anyway. We know that they're going to try to have a look at the numbers that we're putting out, and they're going to build their own models and come up with their own measures. And so what I like to do is make sure that we have enough disclosure to help them get to the right answer. And so we're all looking to get to the right level of information and get to the right calculations. And so I think the more information you can give to the public and the more information you can put in your disclosures to explain what you've done, the better that information is going to be. But I really do focus on reducing the subjectivity, ensuring consistency, and then making sure we have the right disclosures around it.
So, Serena, earlier Heather mentioned that in 2016 when the CD&I came out, AETNA went through an entire review of their use of non-GAAP measures and put some controls around it and put a policy in place, I guess you could say, as to the use of non-GAAP measures. What else have you seen out in the company world and the preparer world as you, as an external auditor, look at some of these things? Are there some best practices that you've seen?
Yeah, we've seen, there's been a number of things that have arisen as a result of the CDNIs being released and also the subsequent comment letter process, right? So since the CDNIs were released, I think the SEC has issued somewhat in excess of 700 comment letters to over 600 companies. Like, it's a lot of non-GAAP measures. Are still a very high volume of comments that the SEC is issuing. And so we've seen an evolution of the interpretation of even the CDNIs through the SEC comment letter process. And so what I would say is I've seen companies rethinking their non-GAAP measures as a result of the CDNIs, but also through the comment letter process. And I would say prominence is one that Keith talked about earlier. It could be as simple as the ordering of the non-GAAP measure, but it could be italics or larger fonts or bolding, even things that you might not think are prominence because it's not ordering, but it is potentially highlighting a non-GAAP measure different, and so companies have been thinking through those types of things. I would also say that the volume of non-GAAP disclosures, so they've taken the opportunity of having the CDNIs and sitting back and thinking, okay, well, 2 CEOs ago we disclosed this because that CEO thought it was an appropriate non-GAAP measure. Like, let's think about it. Do we really need all of this information today? What is truly critical? And they're using it as an avenue to really take a step back and think about what makes sense for them today as they are as a company today, given their industry and their peers and what have you. I would say one of the other issues that came out of the SEC comment letter process, which companies had to address, was this tailored financial principle approach, which is Keith also mentioned earlier. Some sectors that have a large volume of joint ventures have come across this, and this wasn't exactly crystal clear, I would say, in the CDNIs, but it did come through the SEC comment letter process and other avenues that many companies with these large volume of joint venture transactions were disclosing non-GAAP measures, which in effect pro rata consolidated the joint venture. So back out your investment in numbers and add in your pro rata share to show economically what the company is getting. And to many industries, they view that as a very important way to tell the story, right? Particularly if they use off-balance sheet or joint ventures as an investment strategy. And the SEC did not like it at all. And so there was a bit of back and forth with that. Even organizations like NAREIT got involved trying to educate the SEC, and I did see a bit of back and forth with companies in the SEC through the comment letter process. Ultimately, many companies came to a compromise with the SEC. Okay, we won't do this, but are you okay if we do that kind of concept? But there was a lot of discussion.
But not totally.
Add them up. Yeah.
Part of it on the pro rata consolidation, I do remember that a lot of that was driven by the Office of Chief Accountant and the GAAP concerns that that there's a reason, apparently, under GAAP, that that on equity method accounting you have that, and on when you have majority control, you account for it a different way as consolidated and back out the minority interest. And having control of something in the accounting world, I understand, means something and should mean something. And by doing pro rata consolidation, it sort of treated every interest equal. From a minority, the 10% minority interest was the same as a 90%, it just as mathematical. And I think the theory, at least, behind the accounting is that it should be different, because at the 90% level, you really are controlling, that, and you ought to be responsible for the entire consolidated entity as opposed to in the minority instance.
Well, and the pro rata consolidation is just not GAAP, so as well, which is part of the issue, and so they didn't like that presentation. But I would say one of the best practices is to, if you get a comment from the SEC and it is on a measure that you particularly think is important, make sure you spend some time with the SEC to educate them as to why is this an important measure for your story, and then is there a way that you can come to a compromise or a meeting of the minds, which might not get you exactly what you had, but might get you something better than taking it out. So
I think that's a really important point, and Keith, I'd like you to reiterate that, as I'm sure you will, that the Division of Corporation Finance is open for these types of discussions. And so I think they welcome having this discourse with preparers, not just on non-GAAP, but particularly on non-GAAP, to come in and talk to the staff and work through the issue. And a lot of people don't know that and are afraid to come back to the SEC and have that discussion.
Yeah, no, they're open for business. They're happy to talk, happy to be educated, but also be prepared. I mean, bring your A game, because they've seen a lot, they've heard a lot, and you need to be able to make your case.
So, Phil, I want to bring you in. I had earlier asked you about the pitfalls, and you graciously answered that for us. But now I want to ask you, I want to give you the same opportunity to talk about what your internal approach is to using non-GAAP measures.
Sure. Well, clearly, all non-GAAP measures aren't the same in terms of risk level. So you really have to step back and bucket those various non-GAAP measures or KPIs and determine different risk levels for each one. And we talked about the source of the information as being a critical factor in determining risk, right? So if it's coming out of the financial reporting system, there's a lot of controls, and Heather touched on that already as well. You know, making sure that you've got all those controls. You're covered on anything that's coming from the financial reporting system, 404 and all these controls. So you're going to feel pretty good about some of those. But for example, in the hospital industry, admissions data, that's a huge driver for us. And net revenue per admission is a huge driver. So it's a measure of pricing in the industry. And so the questions become, who's calculating those? What, as Heather mentioned, what controls do we have in place around the consistency and, as Keith mentioned, the transparency of those calculations? Those are some of the key factors. Turnover in that. We always view any area within our company as higher risk if there's turnover. And so, if you've got any turnover in an area that is driving some of these non-GAAP measures, we're going to spend more time in those areas. Talking about the source of the data, one I know at HCA is market share data. That's not coming from anywhere inside the company. That's coming clearly from outside sources, state by state. You're basically purchasing market share data, and you're bringing it in-house, and you're altering it in some way, to calculate what you think your market share is, and then you're talking about it on earnings calls. Well, to me, that's going to be an area that I'm going to spend some time in, and I think in those types of areas, I can show a lot of value to our senior management by spending some time in those areas where maybe they're not totally comfortable with where that information is coming from, but yet they're the ones who are delivering it on an earnings call. And so if I can give them a head nod and tell them, yep, I've looked at it, I'm comfortable, and as Heather said, we've established those controls around those non-GAAP areas or KPI areas that are high risk. That's how we look at it at HCA.
So we got a question from one of our viewers. We've talked about consistency, we've talked about prominence. Is there a balance component to non-GAAP? That is, should there be some kind of a ratio between GAAP and non-GAAP measures? Does the SEC look askance? Do you all in your roles look askance if there are many more non-GAAP measures than there are GAAP measures, or as long as you have these other pieces, these other controls in place, are you okay?
I think you're right. I mean, you've got to comply with GAAP, so your GAAP numbers are going to be your GAAP numbers, and I don't think that. As far as non-GAAP, I would say if you present a full non-GAAP income statement, you're going to get a comment, and you're going to get a lot of pushback. Sure. That's just that's way too prominent. You're just really throwing GAAP out the window, at that point. On the other hand, I don't think there's any mathematical formula for how much non-GAAP there can be to GAAP. It depends on what you need to tell your story. But if you follow the principles of transparency and consistency,
the investment community will drive a
Agreed.
lot of that, right? Yeah. They'll tell you what they want to know by, if you don't disclose it, they're going to calculate it and talk about it as they analyze your company. So.
Yeah, and I also think the industry and the sector will drive some of that as well, because you don't want to be an outlier or necessarily providing something that your peer group is not, or So I think
vice versa.
Correct, agreed. Yeah, so I think some of the sector and the industry and your peer group and new entrants to a particular sector will be like, okay, what do they disclose and why do they disclose it? And you see some uniformity. Again, each company often differs from that and may do slightly their own thing to some extent, but I see a lot of pressure from the analyst community and others within a sector to drive some level of uniformity.
I would think that, we talked about consistency and how we calculate the same measures every period, but I would think a red flag could also be if the measures that you present change from period to period.
Agreed.
So if each time you tell your story, it's a little bit of a different tone to the story.
Right.
There's got to be a reason, and so I think to me, a red flag would be if a company has a different measure that they present every period, or one period they present a measure and the next period they don't. You have to ask why.
Right,
is there a reason that they didn't want to put that out there?
Or even a KPI on an earnings call.
That's right.
If you're picking and choosing. Yeah, good point.
Mm-hmm. So we're going to talk a little bit about SEC enforcement actions, and we've gotten a couple questions about abuses, not about particular enforcement actions, but about abuses, which enforcement actions can be a good indicator in and of themselves of abuses. But before I do, I want to ask each one of you, based on a question that we've received from a viewer, do you think there needs to be more guidance or regulation by the SEC, setting aside enforcement actions? Do you have enough guidance from the SEC to know what the expectations are and how to best use non-GAAP?
I would say more guidance is always helpful. And as an auditor, we always say we're here to help. I think the SEC might say that too. That's not always perceived that way. But anytime you have guidance, I think it's helpful. From an auditor perspective, I want rules to audit by, right? And so I don't have a problem with that. I don't think, though, this area is, after all this other guidance has already been put out, I don't see a gap, GAP, in terms of lack of guidance. But
I would agree. I think we have the principles, and we certainly understand the spirit of what the investor community and the SEC is getting at, and we've all heard the message loud and clear, and we've done what we need to do to address it. I think there is probably a tipping point. I don't know that we're there, but there's a tipping point where you could have too much prescriptive guidance, and then you get back to the rules versus principles based argument that we continually like to have as accountants, and you think there's not going to be a magic recipe that says this is the right way to put together your non-GAAP measures. And so I think as long as we have the guiding principles, and if there are incremental guiding principles that could come out, I think those would be helpful to help us apply and understand what the spirit of the rules are. But I think prescription is probably not going to get us to an answer that one size fits all.
Let me go to Serena, and then I'll let you have the last word on that.
Well, I agree. I think the CD&Is were helpful in obviously clarifying certain principles. I would say that the comment letter process since they've been released has also been very helpful to fine-tune some of the expectations of the SEC on certain matters like prominence, like tailored financial principles, etc. And so I would say I feel like we have our arms around it at this point in time as to the expectations. But it is something that we continue to look at, as does the SEC. And so I would say it's not something that we've totally got solved yet. And I think we continue to have to make sure that if you introduce new measures, that you still thinking about these principles.
I think the guidance has gone just about as far as the staff can go based on what the rules are, and so I would not expect to see more guidance from the staff. I think it's a fair question whether the rules should be looked at again. It's been 17 years, I think, ballpark, 15, 16, 17 years since the rule was adopted, and there are some prescriptive things in there. There are things like the prohibition against presenting liquidity per share. Some have argued, well, maybe you should be able to do that. I mean, there's some things that could be talked about. That the idea of you can't back something out, and if you call it recurring, but it's how you label it that determines whether you can back it out or not. I'm not sure that turns out to make the most sense, in the world. Things like that could be looked at, but by and large, I think the guidance is good. I think people know what the answers are. I don't think there's a lot of people flailing around.
Although there are some people flailing around, because if we go to slide 11, right, the SEC will bring an enforcement action if you're flailing around too much or if you take advantage. So we have gotten a couple of questions about abuses, and as a former regulator, I know that the SEC does not issue guidance via enforcement actions, and yet they can be instructive to go back and look and say, okay, here's somebody who's gotten it wrong, and there's been an enforcement action brought. So walk us through, if you will, Keith, some of the recent enforcement actions and what the messages are.
Sure, we'll do that. I mean, I think the overall message, one thing is, they talk about the change of administrations, and when I was there was the so-called broken windows policy, where there were actions brought even on maybe small matters to send a message about what compliance should be like. I don't view non-GAAP cases and the financial fraud cases that are being brought in that category. I think that this administration and any administration is going to bring these types of cases because a lot of them are pressure to meet a guidance and people cutting corners or doing this, that, the other. And we got them up on the screen. The Swisher, case. It was brought in May of 2016. It was the company had publicly guided to an adjusted EBITDA number, but it was just the adjusted EBITDA number happened to be the number they guided to. Could have been a GAAP number, because what happened is during the quarter when they were closing, senior officers in the company directed accounting personnel to manipulate entries not in accordance with GAAP in order to achieve that predetermined adjusted EBITDA number. The staff would put together a list of possible adjustments. And when you have emails that are reflected in the complaint that says, I need you to squeeze the numbers for an additional $220K of EBITDA, those aren't good. That's probably not the kind of email you want to be sending. Not the thing you want to be doing, but set aside that. So, I mean, what were the areas? And these are all probably judgmental areas. I mean, there's purchase accounting and measurement period adjustments. There were adjustments to earnouts, failure to expense employment contracts in connection with acquisitions, and insurance reserves and allocations for doubtful accounts, all GAAP related items, and they were incorrect applications of GAAP where companies were just driving to that number. And once they hit the number, they said, okay, no more, we don't need to do any more adjustments. So that's a one. The MDC Partners case, which is last on the slide, that actually the non-GAAP piece of it came along with another. I guess it was in January 2017 when that case was decided or came out. There was a sort of a celebrated perks thing where they went after the company for some disclosure violations around perquisites. But in addition, the company had some non-GAAP issues. Well, one of the non-GAAP issues was that they'd been told in a comment letter that they were flunking the prominence requirement. And then for the next 6 quarters, they continued to go. They said, oh, we'll fix it. And then for the next 6 quarters, they didn't fix it. Now, maybe shame on someone for not going back and checking whether they were complying with numbers. But I guess my advice to companies is when you tell the SEC you're going to do something, it's probably a good idea to go ahead and do that. I don't think the SEC... Just, I don't think the SEC would have brought a standalone prominence case. I think the fact this was in perks, and then the other aspect of it was the company had presented a number called organic revenue, which made a lot of sense because it was a company that did acquisitions, and when you do acquisitions, it's basically the equivalent of same-store sales for a company that's doing acquisitions. So they back out the effect of acquisitions and foreign exchange impacts when they disclose their numbers. It didn't disclose, however, that in one quarter it shifted the accounting from in a couple of its subsidiaries from gross to net, and went from net to gross actually. And so, in order to be comparable, the company changed what happened in earlier periods, but they didn't explain what it was they were doing. They were showing an organic growth percentage, and they probably got the right comparable percentage growth, but they didn't explain what they were doing, and they didn't reconcile to their GAAP numbers in order to tell what was going on. So on that basis, that was added as part of the complaint.
Sure.
Now again, would those two non-GAAP items have been a standalone case? Maybe, maybe not. The transparency part is important, but that got them into trouble. I think even recently, as we were preparing for this webcast, the enforcement division,
was active.
Giveth more, and they were very active. And these were with KPIs, the constant contact case that's mentioned in Endurance Holdings. The company presented a metric, a subscriber, a paying customers metric, and they had a system, or they had a program in which, if during the last month of a quarter, your contract was going to be up, if you didn't renew, they would give you another free month of service. So they'd keep you on the books and consider you a paying customer for the end of the quarter when they presented the numbers. And of course, they guided the street to their paying customers number. That was an important metric that the street followed, and the company basically over disclosed or over counted the amount of paying customers, because those people may have dropped out after they got the free month. Endurance, which was actually a parent company that acquired Constant Contact, it looked like, they had a subscriber calculation, and it turned out they did it wrong. And after doing the work to figure it out, they found that the amount was overstated, and so they fixed it in the future by basically fuzzying it up. It looked to me as if they created a different way of calculating it, and in doing so they fixed the calculation. Well, the SEC would have none of that. They said it wasn't transparent, and they were trying to jigger that. And then finally, just recently, the KBR case was a backlog case where KBR was charged with incorrectly presenting backlog, not even in the way that they were describing how they calculated it in their 10K, and it resulted in overstatement one year of 14% and another 22%. Now, backlog is not a GAAP number. It's it's not taken from the financial statements, but it's an SEC requirement under in item 10K, and it's taken very seriously in a lot of companies as an indication of what your future business is going to be. And so overstating that by double digits is probably a bad thing. So I think these cases, these kinds of cases are going to be brought in any environment. These are cases that just when you hear about them, they make sense. It doesn't seem like they're petty complaints
or
that the SEC might.
pendulums.
Exactly. No,
Right.
this is
Basic
this is
blocking and
important.
tackling.
Exactly, as a way of getting after appropriate disclosure.
So we've learned 3 important lessons in this little
Only 3?
this segment that we've
Jeff,
had,
right.
that is, if you say you're going to do something, if you tell the SEC you're going to do something, you do it. If you say you're going to calculate non-GAAP measures a particular way, use it that way.
Yeah.
And don't send inflammatory emails.
Right.
Those are the 3 message items I'm coming away with.
Yeah.
But we do have a question that you hinted at when you were talking about the constant contact case. And so I'm going to throw it out there and see if you can give a little more color. The question is there a line, or are there red flags from when a company is using their non-GAAP measures to talk about the company's, the key performance indicators that the company uses, to when they are trying to influence or manipulate investors? Is there a fine line there, or is it pretty cut and dry?
I'm not sure I understand the question.
Well, I think the question's getting at companies use KPIs
Sure.
to tell their story, right?
Right.
When does that move over into trying to influence investors?
Well, I think it's always trying to influence investors. I mean, I think that's the point. And one of the things, and the SEC certainly does it for IPO companies, is when companies put KPIs out there, the SEC staff, in reviewing their IPO registration statement, is really going to look hard and say, okay, tell us how does it relate to your business, but more importantly, how does it relate to how the company is going to make money? And the whole thing with eyeballs and page views and user engagement and what have you, I think they've really put companies to the task of explaining that those aren't in a vacuum. Those need to be related at some point to the financial statements. So of course they're put out there to influence investors,
or at least inform.
Inform, yeah, exactly.
I mean, there's a difference between informing.
Yeah,
and
I didn't mean influence
right?
in a negative way. I mean,
Right.
I think that if it's a metric by which that's an indicator of how company performance is going to improve, I think it's an appropriate indicator to use. So I don't think there's anything wrong with that.
I mean, I would just add, again, we keep talking about these two things, and if there's nothing you don't take away from today, but transparency and consistency, right? These two things, as long as you're doing those things, you shouldn't go across that line, right?
I agree with that. I think the companies that do their disclosures well can easily articulate to the SEC and to others as to why the measure is important to tell their story, and therefore why it's not unduly influencing investors or what have you. But again, as we mentioned before, I think what you disclose is probably going to be somewhat informed by your investor and analyst community, because it's to some extent what they're interested in, right? So so it kind of goes hand in hand to some extent.
So let's move on to slide 12. And what I'd like to do in this segment that the next couple of slides, is talk about the roles and responsibilities of particular members in the financial reporting supply chain. So let's start with the role of the preparer. And so Heather, I'm going to ask you, what do you consider to be your role as a preparer in helping the company consider their non-GAAP and KPIs, and then the presentation of those?
I really consider the role that I play in this instance to be a very large part of the role in the organization. So I see the role of the controller's organization to set the policy and set the tone, and maybe not to use the wrong word, but to sort of make sure, not to enforce the policy, to make sure that it's adhered to and that it's appropriate. And I think we like to put logistics around everything. We're a controller's organization, so we like to have control around things, and even little things that are part of the functionality of which accounts do you use, so that you have 100% accountability for anything that's going to be included or excluded from a non-GAAP measure. I think that's important. I think, to your point, Keith, you don't want to end up with other somewhere, because that's the last thing you want to explain. And so if I have the upfront controls and I know the policy, and everyone knows the policy of what can or cannot be in those accounts, then I have 100% visibility into what's going to be in that calculation. And I can explain it very clearly, and I can articulate it. I think when I look at the overall policy, there's only so much you can do to make it perfunctory or to make it very easy to follow. There is subjectivity. There are things that happen, whether it's a new standard, a new type of transaction, something unusual happens. If you have something that's unusual and it occurs again, is it really unusual? So there's always going to be some subjectivity that's applied. And I think you can only put so much structure around these things. And when it comes to the element of subjectivity, there's only two ways, really, in my opinion, to get at that. One is to take the judgment away from the hands of the masses and to put it into the approvals pipeline, and make sure that it's very transparently communicated, and the approval process for something that doesn't fit squarely in the box of the policy starts with me as the Chief Accounting Officer. No one below that can make a discretionary call, and then it's my job to make some calls, escalate it, and make sure that all the way up through the audit committee people are happy with what we're doing and they understand it. And then the flip side of that is the disclosure. Back to your point that you keep bringing out for us is transparency and disclosure. So whatever those calls are, make sure the policy is clear, make sure people understand it, and then make sure anything that is not very definitively defined is very clearly disclosed in the financial statements. It's easy for people to say, well, we always put our, exclude from our measures similar to EBITDA intangible asset amortization from acquired intangibles. That's easy for people to figure out. But if it's a new accounting standard and you're trying to determine the impact of tax reform and someone needs to make a call on whether or not that should be included or excluded, that's not the kind of thing that I want sort of my general teams to be thinking about. I want to take that responsibility and subjectivity out of their hands.
So let's move on to slide 13 and talk about the role of the audit committee. The audit committee, as the overseer of the preparation of the financial statements, has I think, an important role to play in the company's presentation of their financial information. And so, Keith, let me start with you. Would you expect companies to have both? I think Heather and Phil have indicated that their companies have policies around use of non-GAAP and KPI, but is that a good practice? And then what specifically is the audit committee's role with respect to such a policy?
Right. Well, the short answer is I would expect companies to have it. Companies I represent have it, and as we found out in the roundtables that we did, I think universally it was the case that companies had policies. It was interesting talking about whether those policies should be, how they'd feel about disclosing those policies, and we can talk about that if you'd like. But definitely companies had policies, and it's part of your disclosure controls and procedures. I think companies. Mm-hmm. This is important information that is included in your press releases and often in your SEC filings. So that should be covered by your disclosure controls and procedures. So no question about having a policy. I guess in the shameless plug category, I'd say for the audit committee, just need to look at the roadmap for audit committees that you published, the CAQ published, coming out of the roundtable.
I didn't pay.
No, because it really does lay out exactly what audit committees should be thinking about. I mean, they should review the policies. They should understand from management how they got to this policy. What alternatives did they consider? Why did they reject those alternatives in favor of these? Mm-hmm. They should be looking at the measures that are being used. What's going on in the industry? What are the peers doing? Are we right in the middle here? Are we an outlier? You need to be on top of that. You need to understand how management might make changes to the policy. What would cause management to recommend a change to the policy? And obviously the changes should be coming through the audit committee in any event. You need to discuss with counsel and with your independent auditors their views on the non-GAAP measures that the company is using, not because they're going to bless them but obviously the counsel will know how they fit within the SEC, the Reg G and the Item 10E, and the auditors will have had, I think, a breadth of experience in looking at other types of companies, and they'll be able to offer that. You need to, I think, ask the auditors whether there's anything that they could be involved with in providing assurances. And I know, generally speaking, non-GAAP financial information isn't assured by the auditors, but they do consider it in connection with reading the financial statements and reviewing a 10Q and the like. And there are procedures that could be done if the audit committee wanted them to go further. And
that's actually one of the questions that we got from the audience was, should there be some kind of auditor assurance around a company's non-GAAP, whether it's agreed upon procedures or limited attestation?
Mm-hmm. Yeah, I think it depends. Maybe I don't think there's a yes or no answer. I think some audit companies would like it done, and others wouldn't. I really think actually with the audit committee, and this may be not necessarily in the bailiwick of the financial statements, but KPIs. I think to Phil's point earlier, I mean, that's information that isn't subject to the accounting controls, and so it's almost more important there that the audit committee understand how is this information generated and what assurances do we have, and that's when they talk to folks like Phil and others on the internal audit function, because probably the external auditors aren't going to be in a position to look at that non-financial information, but that's equally as important in this area as the financial information that goes into it. So, I think, and I guess above all, non-GAAP information always starts with GAAP, and so making sure that the company is ticked and tied on their application of GAAP is probably always going to be a good starting place for the audit committee on non-GAAP financial measures.
So, at the roundtable that I participated in, it was a hotly debated topic as to whether non-GAAP measures should be subject to an audit opinion. Yeah. And I think investors and analysts may want that type of assurance, but Phil mentioned it, Keith did as well, is that the information that is used to derive many of these measures is not subject to the same internal control environment that the GAAP information is, and so subjecting that type of information to traditional audit procedures and an opinion would be more difficult. I think there'd have to be a lot of change to the processes and controls in order to make that more readily
Reliable.
available or reliable.
Yeah.
So there's a lot to think about in that concept. It's not as easy as it sounds. But I think, again, there was many discussion at the roundtables about what can be done, and some companies are doing agreed upon procedures with their external audit firms, where they'll say, yes, you have done X, Y, and Z in accordance with your policy or what have you, or we recalculated, we ticked and tied it. So just to give a little additional level of assurance to the audit committee. Some audit committees have engaged external audit firms to look at controls and do some sort of findings and recommendations report. So there are certain other types of limited procedures that can be provided if the audit committee wishes to engage the external audit firm to do so.
Yeah, in the roundtables, that's what we heard mostly, was that the companies that did, the audit committees that did engage the auditor to do enhanced procedures was around the controls. You know, are we following our policy?
Right.
Or if we are changing our policy, do we have a valid reason and a valid justification for changing our
Or
policy?
some benchmarking. I think that's
Right.
some of the other things
That's
that I've
true, yeah.
seen, to look across the industry to
That's
make sure
right.
that you have a consistent set of measures.
Do audit committees ask the audit team, the external auditor, to specifically look at non-GAAP financial measures? You said you consider them as you're looking at the GAAP measures, but do they ask more pointedly to look at the non-GAAP?
It really is varied and dependent upon the audit committee. I would say, since the CD&Is and depending on your industry, particularly if you've had a breach or some sort of fraud related to a non-GAAP measure, we've definitely seen an increase in the requests from audit committees in industries and sectors where there has been a breach that was prominent and very publicly discussed. They want the audit firm to do a findings and recommendations report, or to really look at it. But typically, no, they wouldn't say, tell me that you've looked at it and it's okay, you know, but they may make sure that you've done some sort of level of other procedures. But I would say it really does depend on the industry and the company, and it's more prevalent in sectors or industries where there has been a breach that has been publicly discussed and all the audit committees would be familiar with, yeah.
Yeah, I would say our audit committee doesn't necessarily look to the external audit firm as the keeper of KPIs or non-GAAP, but sometimes they'll look at us from an internal audit perspective and say, you know, are you comfortable with, for example, the guidance? The guidance is where I know our audit committee spends a lot of time learning, okay, how did we calculate this range of guidance that we're about to release to the public, and where are we, you know, in that guidance? Are we near the top? Are we near the bottom? Are we right down the middle? And what have we done in the past? And they ask a lot of questions about the consistency of that earnings guidance. I don't know if that's consistent with what you see, but
you know, if you're a tech company and all you do is back out or add back stock compensation expense, you're probably not going to go to the trouble of doing that. It's all relatively clear. More complicated things, you know, purchase accounting adjustments and things, could be asking the auditors to take a look at that, certainly the internal audit.
So speaking of internal auditors, let's go to slide 14. And you answered some of the question already, but Phil, in your review of non-GAAP measures, what does the internal audit program do? And what would you advise the internal auditors that are watching this as to what their role should be?
I think if I were Keith and I was an attorney, I would say give the attorney answer of it depends. You know, it's never a yes, no. But you know, I think everything is risk-based, and everything that an internal audit team should be doing is risk-based, and stepping back and looking at, you know, to pull in kind of the IIA lines of defense. We tend to look at each one of these types of areas, whether it's non-GAAP measures or GAAP measures or, you know, some clinical risk within the company, and we say, you know, what are the lines of defense that are mitigating this risk? And based on the mitigation of that risk, you determine how much time do I need to spend in this area to provide my management team with some comfort around this. And you know, internal auditors really should be risk managers, and they should be looking at all of these areas, including non-GAAP, And that should always be one of the many things. And I know internal auditors are pulled into many things that they may not have been pulled into in the past. This is an area, though, that I would say does not require boiling the ocean. You don't have to look at every single measure and spend a lot of time. It may just be a few folks at the top end of your pyramid in your team that are just doing a reasonableness test. But then the other end of the spectrum might be that market share data that we talked about, where we're going to need a periodic look at that, and we're gonna need a formal audit report around controls and some of those types of things. So, not a one-size-fits-all, but certainly needs to be part of the plan. And I think my advice to everyone is get involved in this area. And one of the areas that we haven't talked about a lot today yet is this disclosure committee, right? So the linchpin in most companies around this, and Heather, you touched on it, but that disclosure committee that's where a lot of the rubber meets the road. And if your internal audit team is not highly engaged or driving that disclosure committee, they should be. And that's where I think a lot of these discussions around whether it's a new measure that you mentioned, or the transparency, or the potential miscalculations can get caught.
So let's go to slide 15. And Serena, I'm going to start with you.
Sure.
But I'm going to open it up to the entire group.
Okay.
About the role of the external auditor.
Sure.
And so the first question to you is, how do auditors approach their fraud risk assessment and consider non-GAAP measures? And we've gotten a couple of questions about, and this is a subtle distinction, but the questions get to, we're talking about maybe misuse of non-GAAP. But when does it become a fraud risk, or when does it become an indicia of fraud?
Sure. So we, just like internal audit, we do a risk assessment as part of our planning phase of our audit process. And we consider during that planning phase what is important to the company and what is important to their investors and analysts. And is there a particular non-GAAP measure that the company basically lives or dies by, right? Something that's so critical to their business. And then we take a step back and we think, well, does that measure influence management compensation, for example, right? Are they compensated bonus or some sort of stock grants or something like that that's tagged to that non-GAAP measure? And therefore that would obviously increase the risk, right, for fraud around that type of measure. And then we further take a step back and say, okay, so there is potential some incentive there in the fraud triangle, as we know. What is their opportunity to manipulate in order to get to that non-GAAP target that they're looking to get to? And if there is opportunity to manipulate based on certain accounting items that have a significant impact on a non-GAAP measure, we may designate that accounting item as a higher risk of fraud or a fraud risk within the audit, and therefore it would get significantly increased attention. And what we call over and above audit procedures would be applied to that area of accounting, because flow it through, it could ultimately result in manipulation of a non-GAAP measure that is very key, either to achieving results or for management being paid. So that would be one area we would look at. We also look at errors that occur throughout the audit process that we find, and whilst an error may not be quantitatively material, so you could in effect live with it and take it on your summary of audit differences, is that error, is it going to be them meeting or not meeting a non-GAAP measure, which is very important, right? So we consider that as part of our qualitative assessment of errors that we found. And then lastly, I would say if a company does a very big transaction of some sort, we take a step back and we think, okay, why are they structuring it in this fashion? Why have they done the transaction in this way? What is the business purpose of the deal that they've done? And does any of that have an impact on non-GAAP? And if it does, that may indicate that transaction requires a deeper dive or some use of specialists or something like that, because that particular transaction on its own has an increased fraud risk around it.
Serena, you mentioned that one of the things you should be looking at is whether management is compensated on the basis of the non-GAAP measure. And I agree that that's a flag for a fraud risk. On the other hand, if I'm an investor, if you're telling me this number is important, I'd sort of like to know that you're being compensated based on whether you hit that number or not. And so it's not necessarily a bad thing that management is compensated. But it's definitely a flag that requires additional looking, but it may in fact be a good thing that that management is sort of putting its money where its mouth is as far as...
And it may not necessarily mean ultimately that it's a fraud risk, but you need to consider it, because whilst there may be incentive, there may not be opportunity, right? And that's what you need to consider in the fraud triangle in order to determine if it's a fraud risk or not. But as an external auditor, that's all the three components that you should be considering in determining if non-GAAP has a fraud risk associated with it.
So we have a question from an audience member, and that is, in your experience, without naming names, have you ever objected to a company that you're auditing's use of a particular non-GAAP measure, cautioned them that you didn't think that was wise to use that, whether it was EBITDA or another?
I've never cautioned them on the use of a non-GAAP measure, because often, as I said, I often see consistency based in their peer set or industry or what have you. But we have definitely questioned, why are you making that change, or a particular aspect of a transaction. It may not be clear as to how it should be treated for that non-GAAP measure, because it's not something that you've seen in other peers or what have you. And there is a more fulsome discussion around how are you going to treat that for that particular non-GAAP measure, and what does it mean? How would it move that measure per share or what have you? And then yes, we would absolutely make sure that they've been appropriate in their disclosure, so that clear cut, it's apparent to everybody what they've done. Because at the end of the day, and I know this is there's often an expectation gap around this, but it's not my responsibility as an external auditor to make sure that that number is correct. Though we do, obviously, because of many of these issues that we've talked about, spend time understanding consistency and comparability and things like that with the way that they've presented it in the past. And we obviously read the non-GAAP information and make sure it's consistent with the other rest of the information that's disclosed. But our auditor responsibility does not extend to non-GAAP measures. But we understand the focus that it's placed on by investors, and so whilst we could strongly suggest that a company disclose something, if they choose not to at the end of the day, we may raise it to the audit committee that we thought this should be better disclosed, but we can't force them to do so.
Any other points you'd like to make about auditors' responsibility around non-GAAP?
Other than just to say, as I mentioned, we're not responsible for it. We do take it seriously. Like I said, we consider it in our planning process. We devise audit procedures around it if it does increase the risk of our engagement. But our audit opinion does not extend to those numbers, and therefore, I think that's a large expectation gap, is what we saw through the roundtable process for sure. But as I talked about, we can do certain things to help the audit committee. We want to help the audit committee feel good about those numbers, and so if engaged or if requested, we can do an agreed upon procedures or a findings and recommendations report or something like that to help the audit committee gain further comfort around the presentation and disclosure.
So Heather, speaking of the expectations gap, are controls, internal controls around non-GAAP measures subject to management's assessment of internal control over financial reporting, or ICFR?
So they're not part of ICFR, but they are part of our disclosure controls and procedures, obviously. And I would maybe bifurcate them into two different things. I mean, as a preparer, first and foremost, we need to get the numbers right, and they need to be in accordance with GAAP. Mm-hmm. And this non-GAAP concept comes after that. And so right where we started this conversation, that the bedrock of all of the financial reporting is US GAAP, right, and getting that right. And so if we're talking about 3 steps down the line, do we back something out, or do we incrementally add something to present the accurate picture? First thing we have to do is get the numbers right. And so of course that flows through ICFR. And so the calculation of the basic information comes through ICFR. I also think that there is an expectation, maybe back to the expectation gap concept, that if the auditors had a strong opinion that was different from the opinion that was going to be publicly documented, that the audit committee probably would have an expectation to have a conversation. I certainly wouldn't want to know that my auditors had a disagreement or had presented an alternative very different from the decision that we had taken, and I didn't tell anyone about that. So I think there's an official expectation of the auditors, and then I think there's just what's the right thing to do, and how do we have a relationship between the auditors and the preparer.
One quick question from the audience is, and this would be more to Phil and you, Heather, how often do you review or update your policies around non-GAAP? Is that an annual thing?
Policies?
Or your controls,
I would
your
just
policies?
say as necessary. If there
After
is
the
new
SEC
guidance,
issues.
but if it's not broken, we don't try to fix it. Would be but I think you always want to revisit, and so we're always annually looking at the audit committee charter, the internal audit charter, all those documents, the disclosure committee charter. Those are annual things. But there's no set rules, I think, on these types of specific policies.
We typically, as a policy on policies, look at them on a regular basis to make sure that they're still current, they're still accurate, and if it's a hot topic and the SEC is coming out with guidance, is it either through the comment letter process or through CD&Is, then we'll go back and revisit more often. But also, I think about the policies, and I get questions about an exception to the policies. I mean, I think that's probably with any policy that you have, is people ask the question, well, what about this? It's not specifically in the policy. What should I do? Should we have an exception? And if I tend to get many of those, I think maybe the policy is not clear enough, right?
Yeah.
Maybe I do need to go back and put something else in there, or maybe the policy isn't specific enough, or maybe I just need to reinforce that this isn't up for debate, right? This is the policy and we need to stick to it. And so those types of things, either lots of questions from those who are trying to apply it, or a lot of information coming from the outside, would indicate we would go back and look at it. We only had the policy in place for a few years, so it's not that there hasn't been a lot of opportunity, I think, to go back and revisit and for it to get stale, because it's still evolving. But certainly we would look at it.
Well, we're coming up to the end of our time together, so flipping over to slide 16, I'm going to ask each of you, we've covered a lot of information, shared a lot of best practices and a lot of thoughts. So I'm going to ask each of you if there's just one thing that you would wish that our audience would take away from this webcast, what would it be? And so, Heather, I'm going to start with you.
I think if people didn't know I was a controller before the start of this webcast, you certainly do now. But I put the controls in place around it, put some structure around it, and take the mystery away, so that you take the subjectivity out of the process as much as possible and really put some controls and structure around it.
Serena?
So I think we've talked about this ad nauseum, but for me, it's transparency and disclosure is key. So we've talked a lot about issues around consistency and comparability. I think a company can alleviate many of those issues with fulsome and transparent disclosure. I mentioned it earlier on in the webcast. I think the companies that best articulate why they use certain non-GAAP measures and why it's important to telling their story, those are the companies that easily support their use of these measures and why they're not misleading. So I think transparency and disclosure is key.
Phil?
My message is get involved. The whole goal of an internal audit function is to be relevant, and this is an area where you can be relevant, you can show value, and there's a high return on your investment of time.
And Keith, as our former regulator and current securities lawyer, I'm going to give you the last key takeaway.
Right. Well, mine is that bending the rules to achieve a result is wrong, whether it's GAAP or non-GAAP. I think with non-GAAP information, the ability to bend the rules, you can get at the GAAP level and you can get at the non-GAAP level. So it is a higher level of risk and one that needs to be looked at.
Great. Well, thank you all. And I really do want to express my appreciation to each one of you, Phil, Heather, Keith, and Serena. Your insights and thoughts have really been helpful to us at the CAQ and our viewers as well. And I'd also like to thank our viewers for watching today. I would ask that you please take a moment to complete the Webcast survey. You should have a link to that survey that's popped up in a separate window on your computer screen. Your feedback is very helpful to us to improve these webcasts. And for those of you who wish to obtain a copy of your CPE certificate, it will be ready immediately following the webcast. All you have to do is click on the CPE button at the bottom of your screen. If you don't have an opportunity or time to do that right now, you can come back 24 hours later and log back into the event and click the Get CPE icon to get your certificate. If you have any questions regarding the NACD credit, please contact the NACD directly. And for those of you who have colleagues who were not able to join us today, they can view an archive of this webcast, which will be available soon on both the CAQs and the Anti-Fraud Collaborations webcasts. And with that, I'm Cindy Fornelli from the Center for Audit Quality, wishing you all a good rest of the day. Thank you.